So how should investors be positioning ahead of those market-moving events? Well, let's ask Tony Pasquariello. He's the global head of hedge fund coverage at Goldman Sachs. He is back with us again. It's good to see you.
Thank you, Scott.
I mean, what should we be thinking about the market? How are you feeling about it right now?
I think the big dynamics in the game are pretty favorable for risk. Let's start with growth. We think Q3 GDP this week will print 3%.
Okay.
Alongside that, we've got earnings growth plus 8% this year, and as the market looks forward, plus 11% next year. And then the Fed. We think they cut 200 basis points through the cycle. We've got 50 in our pocket, obviously, and another 150 from here until next June. Interplay between the Fed and the economy is in a remarkably friendly place for the stock market. Okay, I think that's probably pretty well known to the market. S&P is looking to be up 11 of the past 12 months. And so where I keep coming out is it's a bull market. The primary trend is higher. The setup's pretty demanding, and so I don't love risk reward. We've got a lot of wood to chop in the next 2 weeks. And so my guess is this is a trader's market with an overarching bias, which is positive.
Are you talking about the wood to chop being tactically over the next 2 weeks is difficult, but get past that, and then we go towards what you said the bigger themes are, stronger growth, Fed's still going to cut, maybe not as much or as big as we once thought, but it's still a bull market despite what could be a messy next couple of weeks?
I think that's right. The sequence being megacap tech, payrolls, of course the election, and then the Fed. I think if you get through that sequence, which is a lot of stimuli.
It's a lot of sequence.
It's a lot.
It's a lot.
But on the other side of that, presuming on net, that's a non-traumatic series of events. I think what you're going to be looking at is a market which has 2 months left on the board. The seasonals turn very favorable. I think there's probably a lot of buybacks to be done in the last 2 months of the year. November is the single best month of the entire year for stock buybacks. That is the single biggest technical in the market. We know the seasonal story, which tends to be very favorable at the end of the year, in addition to election dynamics. And so it sets up well, again, knowing we have to clear a series of hurdles from here to there.
So you use the words traumatic. Not specifically referenced to the election itself or the post-election period. But if that period proves to be more traumatic than maybe some are expecting, would you be a buyer of the dip if it happened in the stock market?
I think there's actually a little bit of risk premium in the price already. And so take a look at the VIX, for example. All year long, S&P 500 has made higher all-time highs. If you look at the 35-year history of the VIX, when S&P makes an all-time high, the average level is 15, not even. We sit here today, it's between 19 and 20. Now, we don't know how much of that is risk premium for the election versus earnings versus payrolls versus the Fed. I mean, again, that's all kind of on the to-do list. But I think that alone, once we get over the hurdle, that decompression of risk premium, I think would stabilize the market.
Okay. The backup in yields. I get the feeling, based on what you've already said, you think it's just a product of stronger than expected growth, not something else to be overly concerned about?
Hard to disassociate exactly what the drivers have been. I think to my eye, it has started with a better than expected run of economic data, which leads to the second point, which is the market's pulled back a little bit some of the expectation for what the Fed will be doing between now and the middle of next year. You've also had some technicals, and then again, I think you also have a market which is telling you the bias of the election is one of reflation. And so that, to this point in the game, I think has been fine. It clearly hasn't stood in the way of parts of the market I like the most, like financials and tech. Our rule of thumb is, if you ask the question, when does basically the bond market impinge on the stock market? It's a 2 standard deviation move in 10-year note yields that is 60 basis points in today's terms. We're about there. And so I do think the further you go in yields, particularly if it comes from a less friendly place, that could impinge on the stock market a little bit.
Okay, you said financials and tech, your 2 favorite places. Let's take them with the latter first. Tech, because we're going to have the Megacap earnings this week, which you have really favored throughout the duration of the year, throughout the last really 2 years of this bull market. Is there any reason to change the bias now towards Megacaps?
Still like them. The setup today, the starting point today, is not what it was 1 year ago when we made that local low, or 2 years ago when we made the big low in October of 2022, right? That's just the law of large numbers. That's the market cap appreciation we've seen since then. I'm still drawn to the earnings power. I'm still drawn to the return of capital. I'm still drawn to the reinvestment of capital. And again, we're going to learn a lot about these buyback numbers and these CapEx numbers this week. I think if I squint, Scott, I can tell myself a story that the setup for Q3 earnings is actually a little bit easier than it was for Q1 earnings and Q2 earnings. I say that with respect to earnings expectation and also positioning. So Goldman Sachs clients, as measured by our prime brokerage data, were sellers of tech stocks in June, July, August, and September. So I actually think, even though NASDAQ's up 7 weeks in a row, thankfully, I actually think there's some room here for these stocks to trade well on good prints.